Welcome, everyone. I'm really excited about this opportunity to speak with Matt. Matt Falconer is a local lender here in Santa Cruz County. He has a wealth of knowledge, and we're really lucky to have him. Hi, Matt. Thanks for joining us.
Hi, thanks for having me today. Excited to
Great.
be here.
Good. So, there's been a lot of changes recently, and the news has been covering, a dramatic increase in mortgage rates. And I think a lot of people don't really know what that translates to. And, there's been a lot of talk of a potential recession. And so I think that people are getting nervous because there's not a lot of concrete information that they can really relate to. So I was hoping that today we could discuss that. And I think that you'd be really helpful in this arena. So my first question is, what has been happening over the last few months? What changes have really been taking place?
Okay, well, there's been a lot of changes. The media is filled with telling us what's going on, and they're all based around inflation. Inflation is making everything really expensive, from houses to gas to restaurants, and everything we spend money on is just way more expensive. Specifically, the interest rates are almost doubled from what they were at the beginning of the year. I was just looking at a chart from Fannie Mae, which is, one of the biggest mortgage companies, a government agency basically also. Rates were at 3% at the beginning of this year, so just not even 6 months ago. And today they are right around 6%. So it's doubled in interest rate, which makes it way more expensive for people to borrow money.
So how does an increase in interest rates affect a buyer's purchasing power rather than a slight increase in purchase prices?
Good question. So the doubling of the interest rate doesn't necessarily mean the payment is doubled. I was doing some math in preparation for this. And so if someone was looking at a $700,000 loan, their mortgage payment was right around $2,950 at a 3% interest rate. So today that payment is $4,200. So it's not double, but it's way more expensive. Mm-hmm. And it really just depends on the person. Some people are still qualified to make that $4,200 payment, and they might still be qualified. Others might not be qualified for that mark, and therefore their purchasing power would go down substantially, hundreds of thousands of dollars lower, because the money is more expensive to borrow. And you couple that also with the appreciation we've seen, that I was curious about what you've seen as well, is the appreciation of the house from, say, $1 million house in January. What's it worth today? Is it already up at like 1.1? Because the property taxes are more expensive.
Mm-hmm. And so from my perspective, from clients with this increase in interest rate, it's very interesting because even week to week, there has been a change in their affordability where they'll come back to me and they'll say, Kaelin, this is way more expensive than I was planning on, and I just can't do it. We have to, change our plans here, and it happened recently when we were in contract and there was a change before the rate was locked, and it dramatically affected their affordability. So I'm seeing that as an agent representing buyers where, it's a very real thing with the majority of my clients. This change in interest rate has affected their purchasing power. Point blank. So from your perspective as the lender, are you experiencing that with your clients where they have to reevaluate, where, week by week, there is a change in their affordability?
Yeah, I am seeing that because as a lender, we have to keep our clients updated. So it's really important that we let the clients know what's going on, because I live in this world of interest rates and mortgages, and you are an expert in real estate, so you live in this world. But the clients, they lean on us and they trust us to guide them through the process and to let them know what's going on. So we have to educate them and update them, because they really don't know. They might look at the news, they might talk to their colleague or their friend or their neighbor, but they don't necessarily understand what it really means for them. So the more communication and education we can offer them, the less surprising it is. Mm-hmm. And so it's, that's one thing that's really important to me, is to keep everybody updated on the process, especially the clients, because the last thing I want to do is have them finally find their dream home with you, and then the next day find out that they can't really afford it. So that's just a big letdown. And, no one likes surprises like that. So we've got to keep them updated.
And so it sounds like you've seen a process like this before, right? It's important to keep people educated. So, with the rise in inflation, the Fed has decided to curtail that. So can you tell me a little bit about this process, what you've seen before, and what people should expect to happen next?
Yes. Okay. So this is a pattern. Absolutely. It's an economic cycle of what happens around any recession. And so this is a really great question. And I've done a lot of research on this. So there's a pattern. Inflation starts to show itself and start to rise. And the Fed doesn't like that because they have this target of around 2%, or they want to keep inflation at a healthy 2%. Things get a little more expensive every year, but not a lot, so just a little bit. We're at 8 or 9%, by the way, right now. So it's way out of bounds. So here's the cycle. Inflation starts to move up way faster than the Fed wants. It's unhealthy for our economy. So what also goes up? The mortgage rates and the housing prices. So everything starts to get more expensive. The Feds, then they use some of their economic tools to start to curb this inflation. So they raise the rates, and that's the news that we're seeing right now. So what happens next is the inflation response. Inflation goes down once the Fed raises the rates, and then what else goes down right after the following step is the mortgage rates go down. And so that's the cycle. Inflation up, Fed rates up, and then the mortgage rates go back down. It's just a cycle, and it's happened at every single recession since the chart I was looking at. It was 9 recessions in a row dating back to something like 1960.
So it's something that's not new. This happens. It's a cycle, ultimately.
Correct.
And what we were talking about earlier was that right now, the everyday consumer is affected because of a rise of inflation. And that affects people's day to day, every single day. And so the Fed has to use whatever tools that they have in order to try to reduce that impact. And so the way that they're able to do that is to raise these rates.
Yeah, you nailed it. Think for people listening a little more bigger picture. The Fed wants it to be more expensive for people to borrow money. And most of us borrow money either on a credit card or a home equity line of credit or a mortgage or an auto loan. The Fed is purposely making it more expensive for fewer people to buy. And the more expensive they make it, it'll slow down our economy and slow down inflation. Because, and also just to kind of keep this in perspective, when inflation is at 8%, it's unhealthy. The people's income, yours, mine, most of everybody's, cannot keep up if inflation goes up 8%, 8%, 8%. People don't get 8% raises every year. They get cost of living increases. Some people get cost of living increases at like 1%. So their wages can't keep up with inflation, and that's why it's not healthy for the economy to grow so fast. It would push people in, it'd be really bad for the economy. So that's why they're trying to make it more expensive for people to borrow money. They're not going to buy the new car. They're not going to overpay for the house. They're not going to maybe rack up their credit card debts. It'll just slow it down a little bit, which is healthy. So no one likes it to be these interest rates to be high, but it overall is very healthy for the economy in the long run.
Right. And so earlier you had said, where were we in January in terms of sale prices versus where we are now? You'll have to forgive me. I got a new computer and it will not let me share my screen. So I'm just going to read these aloud. So in January, our median sale price in all of Santa Cruz County, so that's from Boulder Creek to Watsonville and everything in between, our median sale price was 1.153 with 1.2 months of inventory. So very low inventory, and properties were selling for 104% of the asking price. And then in May, so June statistics aren't out yet, we were at 1.3. So we still appreciated in May. I'm really interested to see what the numbers are going to show for June, but more importantly, July, because I feel like we're going to start to see potential effects in the coming months rather than just immediately. And, in March, our median sale price jumped to 1.6. And what you and I were talking about earlier is, you know, these home prices were just unsustainable, just like you were talking about with inflation at 8%. It's just unsustainable in terms of appreciation happening, 20% in leaps. So, with this change in interest rates, where it's going to get a little bit more expensive for borrowers to buy, it's important for us to look at where we were and where we're headed. So, from your perspective, are you hearing talk? Are you anticipating of these interest rates to continue to rise throughout the rest of the year?
Yeah, rates are the rates will continue to go up until inflation goes down.
Wow.
And so the Fed meets every 6 weeks, by the way. And they've already raised their hand and said in 6 weeks, which is just late July, they plan on raising the interest rates another 0.5, 50 to 75, a half to 3/4 of a point in July. And so that would be another interest rate hike to try to curb inflation. And they basically said, we're going to keep doing this until inflation goes down.
Wow.
Again, because they know the cycle works. But they have to keep using their tools to stop inflation. Taking a little bit of a step back to what you were saying, I want to make sure I heard you right, and I'm pretty sure I did. But you said in January the houses were averaging 1.153, and then in May we're already up to 1.3.
Mm-hmm. We are
So
down from March though, because there was a steady increase, then we went down just a little bit, just as
okay, all right. So there's a little blip there. So that means that the same house was worth 12% more in 5 months. And so what makes the same exact house worth $150,000 more because 6 months has ticked by? Not even 6 months, we're talking 4 months, 5 months. So that's where inflation was inflating the values. It's not like they added $150,000 to the specific property. It's just strictly inflation and supply and demand, by the way.
I was going to say, I feel like that's a big factor in our particular market as well, because there are a lot of factors that drive people here, whether that be the redwoods, proximity to Silicon Valley, the ocean. We have already had a big buyer pool, and other factors, COVID being one of them, had increased already a high buyer pool, which created massive amounts of multiple offers on every single house. I mean, it was such a competitive situation where it really made it a dogged industry here, because it was so concerning that a property would sell in an instant without a buyer's opportunity to even see it with 10 competing offers. So totally. Yeah, I think it's inflation. Obviously there's no way to deny that, but also we just have incredibly low inventory and a huge buyer demand. And so bringing up that point, with an increase of interest rates, with doubling of the interest rates, that likely will translate to a lower amount of buyers being able to purchase certain homes, right?
Totally right. So the way I was going to say this is there's two forces going on. There is inflation, and there's also supply and demand, and these are very, very strong. Like, just the base of the economy, and the base of economics, I should say, is supply and demand. So there are way more buyers because of the beauty, like you said, of our county, and the proximity to Silicon Valley, you name it. Santa Cruz County is highly, highly desirable for so many people, and it's really small. So there's high demand and a short supply, and that's very strong. So even when the houses get really expensive, if there's 10 buyers and the interest rates go really high and that pushes out 5, well, there's still 5 buyers for every 1 house. And those aren't real numbers, but that's just, an explanation of it. So even, and there's cash buyers too. So, I do mortgages. I'm not really sure, who's spending this cash money. but the cash buyers are still there because the interest rates don't matter when you have cash, except for the stock market is getting hammered as well. And so people have less cash because the stock market is down as well. So there's less cash to spend and therefore less, which is a inflationary thing as well. So there's fewer cash buyers, fewer finance buyers, and that will slow the economy. But it's, they're two really strong forces. And no matter what the interest rates are, people are still going to want to buy. And also, to keep this in perspective, you and I know this because we've been doing it for a while, but people that are brand new, rates are almost at 6% is not a high interest rate in the grand scheme of things. It's the highest we've seen in 5 or 10 years, but rates were up in the middle teens, probably for our parents. And I remember talking to people and older clients that say when they got a single digit interest rate, they thought it was the best it was ever going to be at 9.9%. And of course, we saw rates go all the way down to 2s for COVID, but 6 is really not that bad in the grand scheme of things. It's just they've been going up so fast, it's unsettling because no one knows what's next.
And I think it's natural for buyers to get kind of a shell shock feel where it's a dramatic increase, right? And we're going to be seeing them more frequently. And so I want to jump in a little bit more into the statistics, but considering the fact in 6 weeks, we're likely going to have another increase. Do you think for buyers right now that are looking to purchase a home, do you think it's wise for them to try and get a better interest rate that they know that they're going to get now versus what's going to happen in 6 weeks? And before you answer, let me hop into these statistics because we're talking a little bit about the median sale price, but I wanted to mention as well the months of inventory. So to put it in perspective, like you were, we still have high demand and low supply. So when I say inventory, you know this, but for those that may not, that means how quickly homes are absorbed from the market. And, in a neutral market, that would be about 5 months. But ours in January was 1 month of inventory, so incredibly low. May had 1.9, so still incredibly low. We're still going to have low inventory, at least for, the immediate future. But then I like to look at the price reductions, which has been one statistic that has really stood out to me. So to put it in perspective, January, we had 15 price reductions. In March, we had 27. And usually around March is when we start to get a little bit more inventory anyway. So of course there would be some more price reductions just because there's more houses on the market, right?
Mm-hmm.
In May, we had 60 price reductions. That is a number that sticks out to me. And so all that being said, I asked you a question before I stepped into these statistics saying, should people try and take advantage of the interest rates right now, or should they wait? What's your knee-jerk reaction?
My knee-jerk reaction is that people should never necessarily buy a house for the interest rate. If they have a house that they want to live in and they love it, if they can afford the payment, then they should buy the house because it's affordable for their budget and they can afford the payment. If they can't afford the payment, then I don't think they should buy the house because it's unaffordable for them. So it's really about what's affordable to the client, regardless of the interest rate. And that's where the conversations come in with clients is we have to make sure they qualify. But that's just the bank's metric for saying, hey, that's okay. Here, we'll give you a boatload of money and put you in debt. That's just that works for the bank. It doesn't mean it works for our buyers. And it's more important that they buy a house that they can afford and they're not house poor, because there's more to life than making a mortgage payment.
Right.
But this brings up a good question though. So let me see if I can figure out or a good comment. This is a graph of interest rates for the last 50 years. And the gray bars are recessions. And so this is the last 6 recessions for the last 50 years. And you see rates were as high as looks like 18, 19% back in the 80s. And of course, down to where we are in the bottom right-hand corner, they are, this is probably 2 months old because they're not even at 5 yet. So we're over 5. But you can just see by the graph that rates are relatively low in the grand scheme of things. It's just getting crazy in the moment. We're just not used to this spike. But so check this out. Every recession, the rates go down. And this is the end of the cycle. Once inflation goes down, after the Fed raises rates, then inflation goes down, then the rates go back down. So it happened a couple years ago. That's COVID. Then it happened in the Great Recession. That's the housing recession. Then it happened whenever, that's the dot-com recession. And in the that one's the dot-com one, the 90s. Happened there in the 80s, happened there in the 70s, and that's it. Oh, this is a good slide. We'll back a bit, but we'll take a look at the next one. Rates go down. And so I have to believe that this is what's going to happen later. So when I'm talking to our clients, by the way, I give them a payment on what to expect when they're buying this house so they know what they're getting. But I also put in a different graph of what it might look like if they refinance later, because it's highly likely people are going to refinance in a year or in 18 months, whenever we're past this stage of the cycle, they will refinance. So I throw in another column of what the payment might look like for a future payment if they refinance. And then they can see, okay, if rates go back down, then this is a payment that I might be able to get later. And just that kind of helps focus people a little.
So from this graph, can you roughly see, you mentioned 18 months, when it's likely that the Fed will, begin to decrease? Is there any type of trend in what we see?
Not really, because the width of those gray bars is all real different. Like the COVID recent one's real skinny. The housing was a pretty fat one. And so it looks to me like they're anywhere from 6 months to 2 years. And so I don't know how long the recession will be. And technically we're not even in a recession yet, but all signs point to a recession. So it may not happen, but I think my best guess is, I always like to kind of keep things easy. My best guess is 2 years, and we're about halfway through it because the Fed's already raising interest rates because inflation is already up. So we're at the middle of the cycle, and therefore about a year from now, rates will go down.
Right.
And that's just my best educated guess. Look at this next slide though, because this is a great slide. Guess what happens to housing during recessions? It remains strong. Housing, it remains strong through recession. And this is every recession, that's 9 of them, back 70 years. So housing is strong or up in every single recession, except for the Great Recession, which was based on bad loans. So that was like the anomaly. It was completely based on faulty lending and faulty real estate practices. That's why houses went down. It was specifically a housing recession. This is not a housing recession. It's the opposite. Housing is super strong, supply and demand, and there's an all-time low in foreclosures and an all-time high in equity.
Exactly.
People have more equity than they've ever had, which is why there's no foreclosures, because if someone loses their job or whatever, they're not going to just foreclose. They would just sell their house and make a grip of money because their house has gone up in value for 10 years in a row.
Exactly.
So no bubble is happening. It's not based in housing. And I like these. I love these slides. These are just data. It's just facts that happens in every single cycle. So it looks to me like recession's coming, housing's going to remain strong, rates are going to go up, but then they'll go back down. And so it's just a really tricky time that we're in the middle of this kind of funky year.
Yeah, but you know what? Us coming out of COVID, I feel like we're ready for anything. We've come over a lot of hurdles previously. Sure. I feel like us as a people, we can do this. So
here's a different slide if you want to see that. I could go back to, where is it? A lot of these are too much data. Oh, here we go. Here's the pattern. Starting from the left, inflation goes up, mortgage rates go up. Then the Fed raises rates. Then the inflation goes down. It's the inflation response. Then the rates go back down. What happens? Recession. And so that's the pattern we're in, and we're right in the middle. of the Fed raising rates. So we're dead in the middle column. So we're halfway through this pattern, which has happened for 50, 60 years.
So I also wanted to ask, for folks that took out adjustable rate loans or HELOCs, what is something that they should expect now that there has been an increase in interest rate? How does that affect them?
That's a good question. So when the Fed raises the interest rate, that's a short-term interest rate, and that will directly affect anyone's home equity line of credit. If the Fed raises it by a half, their home equity line goes up by a half. So it will change dollar for dollar. And so those are a lot of people have home equity lines of credit because they don't want to mess with their first mortgages because those rates are so low that we got during COVID. So the very good interest rates, people don't want to mess with those. What happens? They get a small HELOC, home equity line of credit, and these are adjustable and it will change. HELOCs, by the way, are set at a margin, which is the lender's profit, and an index. And so the index is called prime rate, and the prime rate is directly correlated to the Fed rate. They move exactly the same. And those are changing rapidly. So people might have had 4%. It's going to be at 7% for the home equity lines by next month.
So that's a home equity line. And then other people have taken out their first mortgages as, adjustable rates. Do you think that it's likely those people are going to want to refinance? Or do you think, with the increase in interest rates, it would be the same, at the end, more of a wash for a 30-year fix if they were going to refinance?
It just depends. That's a good question too. It just depends on the length of that adjustability. So fixed mortgages are conservative and safe because they don't change, and they're fixed for usually 30 years for most first-time home buyers. Adjustables come in different, fixed for a certain time, usually 3, 5, 7, or 10. And so if someone's rate is beginning to adjust now, they might not have a choice and they'll have to refinance. But if they still have a number of years in that fixed period, then they probably should wait and keep the low rate they have until this inflation and the rates go back down. But that's why adjustable rates are tricky and risky. And I'm not a huge advocate for them in general because it's unless people have really deep pockets or really understand what they're getting into, it's risky, especially when it's your house. So I'm very conservative when it comes to things for mortgages.
Yeah.
I had a question for you.
Okay, what's that?
A couple questions. So you said you're already seeing more inventory, right?
Slightly, yes. And just keep in mind though, in the summer months, that's generally what happens anyways. There's usually more houses that come on the market.
Okay, so that's more of a seasonal thing.
Yeah.
All right. Are you seeing longer days on the market?
We're not yet. Again, the June numbers are not out yet. However, we are seeing an increase in the price reductions. But at the same time, we're still seeing 108% sale price to list price. So like I said, while we are seeing subtle changes that I think maybe a snowball effect, I think maybe we'll see some other changes come. We're still having multiple offers, not as many, I would say. A really cute home here in Capitola, I was expecting, 10 offers and there were 3. So it's definitely a different market. It's just these subtle changes and we're still experiencing multiple offers. So we're still seeing the effects of high demand.
Okay, that was my next question that you answered actually. So that's awesome. You knew kind of where I was going. So you're seeing fewer offers.
Yes. Yeah.
Okay, but still strong offers, just not as many.
Exactly. Like we were talking about earlier, if there are competing people, that's where these high prices come from, is when people are competing against each other. And if they can afford it, and if they want it, and they're willing to pay for it, that in the end of the day is going to be what wins. So currently right now, this is what we're seeing. I'm not sure if that's what we're going to be seeing, 3 months from now, when perhaps there is fatigue, with the increase of interest rates, especially if they get raised again, and what that's going to translate to. We were also talking earlier, we've always been kind of a cash heavy market, whether that be all cash offers or, a very strong down payment, 30, 40% would not be uncommon. When we were talking earlier, it kind of set off an alarm for me. Like, actually, I haven't really been seeing that much cash offers, and I haven't really been seeing that strong of down payments. And you brought up a great point about the effect on the stock market is affecting people's cash purchasing power. So there's all these little facets that I think combined together are slowly going to start to show effects in the coming months.
Yeah. Are you seeing different changes in different price points? I'm just going to kind of say under $1 million, over $1 million, or something like that. Is it more competitive at the under $1 million, or is it more competitive between $1 million to $1.5 million? Are there any?
I have a great slide for this. Let me see if I have it in here.
Because each segment has a different kind of buyer, and the higher the price point, the more qualified the buyer.
Right. Well, I'd say I directly, most recently this year, am dealing directly with, 1, 2, and over. So that's my direct experience, but it just, logic will tell you there are more buyers able to buy less than $1 million than are over $1 million. That's just logic, right? More people
Sure.
can afford a lower price point than they can a higher price point.
Right, but
And
those are the people that the interest rate changes and their payment changes, and then they can't have enough. They can't necessarily afford that because they don't have the extra income to buffer the higher mortgage payment.
Right. And so when we talk about under $1 million too, we're talking about reasonable entry level buyers right now. And so as we increase that interest rate, those are the ones that are going to be more dramatically affected. And so that's why it's just going to be very interesting to see what happens in the next, few months, because as people are pushed out of the higher price point, they're all cramming down into the same inventory, and it's not going to get any greater is my assumption.
Right. Something I've been seeing, I'm wondering if you have as well, is sellers were, a couple months ago, they're holding all the cards. There's no concessions, and they're not bending at all. I'm seeing now buyers asking for more concessions, asking for seller credits, and getting them. You seeing much of that?
I have been successful, however, as a buyer agent in situations like that. However, I would say again, we are still having multiple offers. I would say it would be wrong to set that expectation that a buyer can ask for what they want. If you're competing against other buyers, I'm sorry, the seller still holds the cards. And that's what I'm telling my seller clients as well. While there is an increase in interest rates, that doesn't change the fact that the buyer pool is still incredibly strong and that we are seeing multiple offers. So while in the next few months, we may see other changes, I'm not seeing them now. And especially if there is a backup offer in place, buyers still want these homes. And so I'm not seeing, $5,000 towards credit closing costs at this point. I'm not seeing that.
Okay. You mentioned something that I really didn't have on the radar for this meeting, so to speak. Backup offers. I feel like that's underutilized for our clients. Do you use that strategy to help your clients get into offer? Because the data says that 25% of the transactions nowadays either close late or fall out.
Let me tell you something. This is the absolute time to utilize backup offers because of exactly what you said earlier. Week by week, people's purchasing power is changing. So if a buyer gets into contract with a loan contingency or just a loan, there is a strong chance that their purchasing power is going to change while in escrow. Given the information that we have, 6 months from now, it's possible that interest rates are going to go up again. So I tell clients, I tell other agents, definitely utilize a backup offer because the odds of something changing are going to increase given the information and the changing market that we're in right now. So if as a buyer, you've lost out, I'm not saying, hold on to that string of hope. I'm just saying, don't give up. there is a chance something is going to happen. So absolutely use backup offers.
Yeah. And if I would say, if you are a buyer and you get into a backup position, there's no risk. You're there,
Exactly.
you're holding your place. And why not? There's nothing hindering you from looking at other houses. There's nothing, you're not giving up. That's a good analogy for it. It also puts pressure on the other buyers to perform.
Exactly.
And so it helps the seller. It really helps the sellers.
But it helps you as well because you agree to terms up front. The seller can't say, well, actually, I want this, this, and this. You're agreeing to the terms up front. And I like to say you're engaged, you're not married. We can still go and look at houses and have a grand old time. And if you find a better opportunity, let's go for it. But let's at least keep this in place where you're going to be happy and absolutely love these terms. Let's at least utilize that option for you.
I love it. That's an engaged, not married. That's great. I just don't see it happening very much, and I feel it's super underutilized. I'm glad to hear you doing that for your clients because it's strategic. So it's
Exactly.
awesome. That's great. I didn't really have any other questions for you besides the concessions and what you already answered, but the market's tricky and it's changing. People throw around the word crazy, which I'm not an advocate for. What it is it's complex. And so when it's complex, you need someone that knows what they're doing, like yourself. And so it's they're in good hands with you.
Thank you, Matt. So what's a good way for people to get a hold of you? Because clearly you're an absolute wonderful resource in this. So what's the best way for someone to reach out to you if they're interested in getting a mortgage, or honestly, if they just have questions about their current mortgage, what's the best way to get a hold of you?
Yeah, a phone call is the easiest way to get a hold of me. Email's great too. They could call you and then you can put them in touch with me. My phone number is 831-435-9197. But to your point is, I really like educating people in general and clients. You think about what we're talking about, buying $1 million, $2 million, whatever, hundreds of thousands of dollars. It all starts with helping people understand what they're doing. And if I can help them do that, then that's a win for me. And if they buy a house now, great. If they buy a house later, then whatever, that's fine too. Or not at all. I like helping, and that's always been the cornerstone of my business. And then people tell their friends that Matt was helpful and educated me, and that helps me grow my business. So I welcome any and all questions, and thank you.
Absolutely. So I'm hoping that we can do this again 6 weeks from now. And hopefully we'll have some more fun, interesting things to talk about. So we'll connect about that. And I will include a link to your information down below in this. And have a great rest of your day, Matt. Thank you so much again.
Thank you. Talk to you.
Okay, bye.